Money market. So first we'll take a look at some of the basic terms in money market. And even before that, we'll try to see what Reserve Bank of India is. It is a central authority in the governance of banking system in India. So we'll first see what is Reserve Bank of India and what is its authority. So it's a central authority in the governance of banking system in India, and it also brings in policy changes for the bank. So in relation to money market, we have to be familiar with the following terms, which are cash reserve ratio, statutory liquidity ratio, demand and time liabilities, which has two parts, demand liabilities and time liabilities. So first we'll take a look at what is cash reserve ratio. So cash reserve ratio is the percentage of bank's total deposit if it needs to maintain as cash. It does not earn any interest on that portion, neither it can be used for loans, etc. So that is cash reserve ratio of a bank. Now, what is statutory liquidity ratio? It is actually the proportion of liquid assets to demand time liabilities. Now, what is exactly demand time liabilities? Demand and time liabilities have two portions. One is demand liabilities and time liabilities. So demand liabilities are all liabilities which are payable by the bank on demand from customers. What are some of those examples? What is examples of demand liability? Examples may be current deposits, demand portion of savings bank deposit, etc. So those are the examples of demand liabilities. Remember, demand liabilities are all liabilities which are payable by the bank on demand from the customers. Now, what is time liability? Time liability are payable otherwise than on demand. Examples are fixed deposits, cash certificates, etc. So this is some context in the case of money market, and we will see, even though briefly, we will see what exactly are the other concepts which exist in money market. So some of the basic concepts in money market are money market aggregates or monetary aggregates. We will see what exactly that is. We will see there are different types of money market aggregates. We will go through them, M0, M1, M2, M3. Then we will see what is call and notice money market. We'll also see what is government securities, and also we will see treasury bills. So first we will take a look at what is money market aggregates or monetary aggregates. During 1970, monetary stock measures were introduced by the Reserve Bank of India and later under the working group chaired by Mr. Y.B. Reddy, who suggested more changes in 1997 till 1998. So according to those measures, monetary aggregates were classified as M0 or weekly reports of currency in circulation. This also included bankers' deposits with RBI and other deposits with RBI. The other classification was again M1 or narrow money, which was whatever categorically currency which existed with public, current deposits in the banking system, and 15% of demand time liability portion of savings deposits with the banking system. So these were termed as M1 or narrow money. Monetary aggregates also has M2 or fortnightly report. What is exactly that? It is M1 included with time liabilities portion or 85% of demand time liability of savings deposit with the banks, certificate of deposits issued by banks, and term deposits excluding FCNR B. That is what is M2 or fortnightly report. And finally, there is M3 or broad money, which is M2 with time deposits and call borrowings. So these are the monetary aggregates which forms some basis in money market. It will be more relevant when we take a look at the money market instruments and so on, which will be dealt in another session actually. Now let us see what is call and notice money market. The call money market is important in money market where funds may get transacted on an overnight basis, and in notice money market, and so that is what is called money market. So in call money market, funds may get transacted on an overnight basis. It won't be a few days or a week. It'll be an overnight basis. Funds may get transacted. Whereas notice money market, what exactly is that? Notice money market, funds are transacted within a period of under a fortnight, under 14 days. Next, we'll take a look at what is government securities. Short sell indicates sale of government securities by a bank who do not own the government securities with an understanding to deliver the security at a future date. So in government securities, in the case of government securities, short sell indicates that the government securities are, the sale of it by a bank is by not owning the government securities, but with an understanding to deliver the security at a future date. The main purpose of selling the government security is to enhance liquidity in the GSEC market and to give a view of two-way view on interest rate to participants involved in the market. Banks also participate and undertake notional short sale where a security is sold short from HFT or held for trade, even if it is held under AFS, alternate financial services, or held to maturity. So that sums up what is government securities. And next is treasury bills. We'll see what they are. They are short-term instruments used by central or state government to borrow and also used as promissory notes issued at a discount. They were first issued in the year 1917 in India. Now, these are issued to meet expenditure and also to park surplus funds which are temporary in nature from the investors. Treasury bill can be purchased by anyone except state government and are issued by RBI and sold through auctions conducted on a fortnightly or monthly basis. Normally, the face value of treasury bill is rupees 1 lakh or 100,000 or multiples of it thereof. The rate of maturity of treasury bill is 91 days, 184 days or 364 days. The rate of interest of treasury bill is determined by the money market based on the demand and supply of funds in the market. So it actually fluctuates. It is determined by the money market and it is based on demand and supply of funds in the market. So that covers the basic concepts in money market. Thank you.